Hello, Econ 151 students. This week's lesson is Lesson 10. It deals with Chapter 16, the monetary system. In this chapter, we're going to look at money, the Federal Reserve, how banks work with the Federal Reserve and how banks create money, and how the Federal Reserve impacts the money supply and controls that money supply. So we start with an examination of the concept of money, what it is, and why we need it. And it starts in your textbook. If you read chapter 16, it's an excellent chapter, and you'll see that it starts with an understanding of how barter works and how barter requires this double coincidence of wants. And because of that, it makes trade very difficult, and because it's very unlikely that two people are going to have exactly the thing the other one wants at that exact moment. So because of this, most people would have just huge transaction costs trying to make trades with each other. And what happens is money can step in and serve as an intermediary so that people can make these exchanges easily and quickly without needing to have that double coincidence. Money has three functions. Mainly it serves as a medium of exchange, so that intermediary between two parties when they're making that exchange. It serves as a unit of count, which is a way of measuring prices and debts, and it serves as a store of value where it allows purchasing power to move from one time period to another. The two kinds of money that we typically understand are commodity money, which is something that has intrinsic value. So a commodity, silver, gold, cigarettes, like they explain in the books, something like that, where commodities are being exchanged and it's used as money. And some examples here would be gold coins and cigarettes in POW camps. And then there's also fiat money, which is money by government fiat. It's by government order that it has value. It does not have intrinsic value, but because the government decrees that it should, then it has value. And so the US dollar would be a good example of fiat money. The money supply, also known as the money stock, is how much money is available in the economy in general. And we have two parts of the money supply. We have currency, which we would count as paper and bills, and demand deposits. Those deposits that are in what we call checkable deposits. So they're balances in bank accounts that you can access on demand by writing a check or through the use anymore of a debit card. The way we measure the money supply in the United States is we identify M1, which is the most liquid form of money, meaning it's most readily available and can be used as final payment for goods and services. And that is currency, which would include coins, demand deposits, these checkable deposits, traveler's checks, and any other checkable deposits, perhaps a very liquid money market account, something like that, that has checks connected with it. M1 as of September 2013 is 2.6 trillion. It's a little bit more now. M2 is M1 plus some additional things that are what we'd call near money. That would be savings deposits, small time deposits. By small, they mean under generally $100,000. Money market mutual funds, and a few minor categories that would also be categorized as pretty liquid, not as liquid as M1. Excuse me. So M2 then in September of 2013 was 10.8 trillion. So you can see that there's a lot more in near money than there is in readily available cash. And so in this course and in this text, we won't be making distinguishing or discernments between M1 and M2. We will simply refer to the money supply. To understand the money supply, we need to understand the concept of a central bank. A central bank is kind of what it sounds like, a banking institution that oversees the entire banking system and helps to regulate the money supply. The banking system, or the central bank, will make monetary policy, which is the policies made by the central bank that affect the banks within the system. In the United States, we call this the Federal Reserve, or the Fed, and that's a system of 12 banks with branch offices that has a chairman, a board of governors with a chairman, This is 7 members. They're located in Washington, D.C. And then you have the 12 regional banks that essentially serve as banks to the banks. And those are located around the United States. The other part of the Federal Reserve System that's really integral is the Federal Open Market Committee, which is part of the Board of Governors and then also consists of the heads of some of the regional banks. And as you'll see in the text, always includes the head of the New York Fed, and we'll talk about that later. And they decide monetary policy. The Federal Open Market Committee, generally speaking, makes the vast majority of the decisions about monetary policy. To understand this policy and why it needs to be made, we need to understand the fractional reserve banking system, where banks keep only a fraction of deposits as reserves and the rest is used to make loans. The Fed will establish reserve requirements, which are regulations on how much must be kept in reserve, and that's going to influence how much can be made in loans. The amount that must be held in reserve is going to be adjusted to make different loan amounts possible. Banks can hold more than this. We would call that excess reserves. If they choose to do so, they can do that, but there is a minimum established by the Fed, and this is called the reserve ratio, and it's indicated with the letter R, and that is, by definition, the fraction of deposits the banks hold as reserves. Now, an important note here is that even though it doesn't say so in the book, when they talk about banks making loans based on the amount that is held in banks, they're not actually talking about that money itself being loaned out. And you'll see when we go through the balance sheets, those T-charts, that what the banks actually do is make loans equal to the amount of deposits that are held, not actually loan out those deposits. So when we're talking about the reserve ratio, we're talking about what is required to be held versus what then is available as a basis for loans. So the bank's T account is really a very simple accounting statement showing assets and liabilities. And so here's a good example of one. You've got a bank here, with deposits of $100, and those would be liabilities because those are owed to the depositors. And on the other side, the assets would be the reserves that are held and the loans that are issued because those are going to be repaid, so those are long-term assets at the bank. And you can see that using this example here, the reserve requirement or the reserve ratio is, we take the reserve ratio of $10 in actual reserves divided by the $100 on deposit, and we can see that the reserve ratio here is 10%. So just to give an example of how banks affect the money supply, let's say there's $100 of currency, which we agree is money, is in circulation, and we want to understand how banks impact the money supply. And we can find 3 different scenarios where we can see the money supply changing. So the first one is if there's no banking system. The second one is if we have a 100% reserve banking system. The third one is a fractional reserve banking system. So this gives you a good opportunity to see what happens. So in the first case where there's no banking system, the public holds the $100 as currency. The money supply is that $100 in currency. In case 2, the 100% reserve banking system, the public deposits their money at the bank. The First National Bank, in this case, holds on to 100% of the deposits. The liabilities then are the $100 in deposit. The reserves are $100 as an asset. Those balance, as these charts always must, and really it does not affect the money supply at all because the currency plus the deposits are $100. So in a 100% reserve banking system, banks really have no effect on the size of the money supply. So we'll go to the third case, which is the fractional and reserve banking system that we have. And we can say that, let's say that the rule is, the ratio is set at 10%. If First National Bank loans out all but 10% of that $100 deposit, we can see that they're holding the $10 that's required. they're making loans equal to the remaining $90. And still, the depositors have $100 on deposit. And I think that's where it's important to make this distinction between loaning out deposits and making loans equal to deposits. So those deposits didn't go anywhere. So there's still that $100 on deposit. However, now the assets have grown. They've gone from $10 to an additional $90 in assets. Now those loans that are made put money in the hands of depositors or lenders or borrowers in this case. So the money supply has grown. You've got your $90 in new loans. You've got your $100 in the original deposits that still exist. They didn't go anywhere. And now you have a money supply of $190. So you can see the effect here of the growth of the money supply through this lending of the fractional reserve system. And the bottom line is that when banks make loans, they create money. The borrower gets the money. That $90 in currency is real. It's money. They can take that check that they receive or that cash they receive to a bank, put it into a checkable deposit, and it becomes money. Or they can cash it and turn it into currency and it becomes money. And that is counted in the money supply. That $90 in new debt becomes a liability that doesn't have an offsetting effect on the money supply. So there's no offsetting asset. And so that $90 in new debt becomes a liability and it must be repaid in the future. So what you've seen here is a fractional reserve banking system is creating money. Now the key to this is it's creating money. It's adding $90 to the money supply, but it did not create wealth. And that's why it's important to recognize that it creates $90 in new debt, which offsets that $90 in currency. So while people are experiencing growth in the money supply, the individual that borrowed that money has no change in their wealth. They have $90 in their pocket, but they owe $90. And so their wealth is not changed by that. So a fractional reserve system does this in much, much larger numbers, as you can imagine. So every time a loan is issued, it added to the money supply. So what banks have then is this tremendous power to influence the money supply, which brings us to, I think, a better understanding of why we need a central bank. Because if banks have this power to add to the money supply like this, then there's going to need to be some way of managing that. Now here imagine that the borrower of that $90 takes their deposit to the Second National Bank. And initially, here's what their deposits look like, and here's what their reserves look like. And now they're going to take it, they're going to deposit it, of course, and let's say Second National Bank has to also hold on to 10% as required reserves. They're going to create loans equal to all but 10% of that deposit. And so you can see that they're going to hold $9 of that $90 deposit in required reserves. They're going to create loans equal to $81. And again, you can see the growth of the money supply through this lending process. And now it continues. That borrower of the $81 takes that money that is actually money now. They take it to the Third National Bank. They make a deposit and they hold on to 10% of that deposit if that's the reserve requirement. And they're going to hold on to 10% and make loans equal to all but 10% of that deposit. And you can see how this process continues and continues. And with each new loan, more and more money is created. Now, if we follow this all the way to its logical conclusion, we could calculate this on pretty much endlessly until we come to a final number. And what we can see is the money supply in total would increase from that original deposit of $100 to $1,000. And so this is our example that we see here. In this case, because of that 10% reserve requirement, that $100 through that process of creating money and depositing each one and each additional loan and holding on to 10% generates $1,000 worth of money into the money supply. This is what we call the money multiplier effect. What you just saw there was the amount of money that the system generates with each dollar of reserves. And so the way to calculate the money multiplier is to take 1 divided by the reserve requirement, and it's going to give us a multiplier that we can multiply each dollar by, and each dollar added to the reserve system, and we can see what it will eventually create in terms of money in the money supply. So the example we just had where the reserve requirement was 10%, the money multiplier, 1 divided by that, would be 10. So for each dollar that is generated in new money, you're going to have $10 that are created through this reserve requirement process, this money multiplier process. And so $100 of reserves, in this case, creates $1,000 worth of money. And if you're not sure how that happens, go back through that example, and you can see that with each loan that is made, 10% is held, the additional 90% loans are issued equal to that, and that money is generated, and it adds, and it adds. So this is the money multiplier effect. So there's a practice opportunity in here for you that asks you to consider the effects of a $50 deposit to your checking account with a 20% reserve requirement. And you're asked to calculate the maximum amount and the minimum amount that the money supply would increase. The easiest way to approach this is to calculate the money multiplier from this. So you're going to take 1 divided by that reserve requirement of 20%, and it should become pretty easy after that. So let's go through this. 1 over the reserve requirement of 20% gives us a multiplier of 5. And so multiplying that original $50 deposit by 5 gives us $250. But one thing to keep in mind is that the money supply includes currency, which in this case falls by $50, so your maximum increase in the money supply is really $200. The minimum amount would be 0. If your bank makes no loans from your deposit, then currency falls by $50, deposits increase by $50, there's a wash, and the money supply isn't affected by that. A few other things to know about the balance sheet of a bank is that besides reserves and loans, banks also hold securities, and besides deposits, they have additional liabilities, funds from issuing debt and equity. Bank capital would be the resources a bank obtains by issuing equity to its owners. Leverage would be the use of borrowed funds to supplement existing funds for investment purposes. So looking at a bank's balance sheet in a more realistic fashion would show us this thing called leverage ratio, and that's the ratio of assets to bank capital. So in this example, you've got a leverage ratio of 1,000 to 50, which gives you this value of 20. And what that tells you is that for every $20 in assets, $1 is from the bank's owners, and $19 is leveraged or financed with borrowed money. An important thing to know. So leverage can amplify profits and losses. And so in the example you just saw, if the bank assets appreciate by 5% from 1,000 to 1,050, then bank capital increases from $50 to $100, which doubles owner's equity. And so if instead bank assets decrease by 5%, then bank capital falls from $50 to 0. And if bank assets were to decrease by more than 5%, the bank would have negative capital and they would be deemed insolvent. So there's this capital requirement that requires that the banks maintain a minimum amount of capital that ensures that the banks will be able to pay off their depositors and their debts. So on their balance sheet, it's very important that they have this. And the reason that this is an important thing to understand, we can see it most recently in the financial crisis of 2008, 2009, the banks were holding on to a lot of bad debt, mostly losses on mortgage loans and mortgage-backed securities, and this had to do with the defaults that were going on. Many banks became what we call undercapitalized or insolvent, and in the United States, 27 banks failed from 2000 to 2007. However, during this crisis alone, just in 2 years' time, 166 failed. So lots and lots of banks found themselves with not enough capital, And they responded by reducing lending, which created a credit crunch, which affected borrowers in all different areas. The government stepped in to deal with the credit crunch. The Federal Reserve and the Treasury injected just hundreds of billions of dollars worth of capital into the banking system. And this was to solve that problem of banks being undercapitalized. And it was a temporary policy. It was unusual move by the Fed, and it made the U.S. taxpayers part owners of many banks. And this was the bailouts, the TARP that we saw, the Troubled Asset Relief Program. And a lot of people were aware of this, that U.S. taxpayers' money was being used to capitalize these banks, making them part owners. And the policies did help to recapitalize the banks and the banking system, and did help get to some sense of normality by 2009. And it's continued since then to kind of even out and be a little more stable. Next, we're going to look at the tools that the Fed uses to control the money supply. We learned earlier that the money supply is the money multiplier times the amount of reserves in the banks. And the Fed has several tools that it can use to influence the amount of reserves in the money supply, the amount of money that's available for lending. The open market operations is the primary method that is used. This is the buying and selling of government securities by the Fed. If they buy a government security, they pay by depositing new reserves in that bank's reserve account that they have with the Federal Reserve. And so they pay by giving them more lending ability. So buying bonds increases the amount of reserves that banks have on hand, increasing their ability to lend. If they sell bonds, then it does the opposite. The banks pay through the reserve system. It takes reserves out of the system, transfers it to the Fed. That decreases the bank's ability to make loans and shrinks the money supply. Another way the Fed can influence the amount of loans that banks make is to increase their reserves. The traditional method is by adjusting the discount rate, which is the rate that the banks can borrow from the Fed at, and this would be an incentive for them to either borrow more or less. And that's the traditional method. Now, there's a new method that's referred to as term auction facility, and the Fed basically makes a decision about how much it's going to loan, and the banks bid for these loans. And they bid against each other, and when they're bidding, they're looking at the price of the loan, which is the interest rate they're going to pay. The more the banks borrow, the more the reserves are available for funding new loans, and this is going to increase the money supply. So if rates are low, that's going to encourage borrowing by the banks, which in turn will create more lending capacity for the banks. If interest rates are higher, that discourages borrowing by the banks, which in turn discourages lending by the banks. So all of this is done to increase the amount of lending that banks do through the policies of the Fed. Another thing that the Fed can do is influence the reserve ratio. They can change it. They are responsible for setting that ratio. And if you remember, the ratio is reserves to deposits, and it affects the money multiplier inversely. So the higher the ratio, the lower the money multiplier. The lower the ratio, the higher the money multiplier. The Fed is responsible for setting these reserve requirements, and it's a regulation that they set, and it determines how much the banks are going to be holding against their deposits. When they reduce the reserve requirements, they allow more lending to take place, and they increase the multiplier. If they raise the reserve requirements, they will raise the reserve ratio and decrease the money multiplier, resulting in less lending. So another thing that they do, the Fed, to influence the reserve ratio is they now pay interest. And this is a new policy that happened in 2008. The Fed pays interest on reserves that banks keep in their accounts at the Fed, because the Fed is the bank to the banks. When they raise that interest rate, that incentivizes the banks to keep their money there and enjoy the nice payment of interest, risk-free. And this decreases the money supply, because if the banks are holding their money with the Fed, earning interest on it, they're not loaning it out and creating money and adding to the money supply. And of course, it has the reverse effect. If they lower that interest rate, they're going to disincentivize the banks from holding their money at the Fed. The banks are better off taking their chances loaning that money out. It's going to be more profitable to them. So they can influence how much money the banks keep on reserve with the Fed through that interest rate. There are problems, of course, controlling the money supply. It's pretty predictable, but it's not an exact science because we're dealing with people here. If households decide to hold on to more of their money, then banks have fewer reserves because they have less deposits to work with. And if banks hold on to more reserves than are required of them, they keep excess reserves, they make fewer loans and the money supply falls. So the Fed can incentivize and they can create policy, but they can't really control it absolutely. The Fed can compensate for household and bank behavior to have fairly precise control over the money supply, but again, it's not perfectly precise. Another concept to understand in this chapter is the idea of a bank run. And this is something that we don't see anymore because of the new system, well, newish system that insures deposits. So it alleviates people's fears. But there have been these things called a run on banks, when people literally run to the bank to withdraw their funds because they feel uncomfortable or nervous about the safety of their money. And with a fractional reserve banking system, the banks wouldn't hold enough in reserve to pay off all their depositors at once, which of course creates all kinds of problems. As a result, banks might make fewer loans, hold on to more reserves for future situations like this, and this would increase the reserve requirement. It would cause the reversal of the money creation process and cause the money supply to fall. In the time of the Great Depression, the early years of the Great Depression, a wave of bank runs and bank closing caused a total decrease in the money supply of about 28%. And a lot of this is part of what led to the Great Depression. It really wasn't a single cause, but it certainly had an effect and caused the Great Depression at least to be longer and probably more severe than it would have been otherwise. And since this time, we've had federal deposit insurance that helps people to know that their money is insured and avoid a lot of bank runs and problems like that. In the United Kingdom, though, you had not too long ago, the Northern Rock Bank experienced what we'd call a classic bank run and was taken over by the British government. The federal funds rate is something to understand because this is the rate at which banks loan each other money in the what we call the excess reserves money market. So on any given day, banks with insufficient reserves can borrow from banks with excess reserves. And those excess reserves exist in a market, just like any other market. And this happens to be a market where the excess reserves of all banks are kind of exchanged. The interest rate in this market would be the price, and this is what we call the federal funds rate. And the Federal Open Market Committee uses open market operations, which is the buying and selling of bonds, to target the federal funds rate. Now we're going to have a minute to explore that as your book goes through it. But first, a quick look at how the federal funds rate moves with other rates over time. And they're pretty consistent and they move in the same patterns. Now, to understand this federal funds rate in terms of this market for excess reserves, you can see we call this the federal funds market. You've got the rate, you've got supply and demand in the market, as you might expect, and you've got the quantity of funds on the horizontal axis. So there's your typical market. In this case, we set a market rate at 1.5%. And remember, when we say market rate, it's determined by supply and demand in the market. And the supply is that amount of excess reserves. Demand is the banks and their demand for loans in this market. So to raise that federal funds rate, to set that higher target, the Fed can sell government bonds through open market operations. That's what it's called. And what this does is it removes reserves from the system. It reduces the supply of federal funds. And what you can see automatically is that it's going to cause that federal funds rate to rise. And you can see that if we went the other way with that, it would, we could show that if the Fed were to buy government bonds, then it's going to lower demand for loans, because now when they buy government bonds, they put money into the excess reserves of the banks. The banks then have the money they want to loan. They're not as likely to borrow in the federal funds market. It's going to decrease the demand for loans, and you're going to see that interest rate become lower. So the Fed has some power here through open market operations to increase and decrease this federal funds rate. It's not an exact science. They don't change it themselves, but they do use their policies to influence those changes. To summarize this chapter, you've got the functions of money, medium of exchange, unit of account, store of value. You should understand the differences between commodity money and fiat money. Understand that the United States uses fiat money. Understand the fractional reserve banking system and how banks create money when they make loans. And understand that multiplier effect on the money supply is part of the loans that banks make. And understand how a bank can become undercapitalized because they're highly leveraged, and that to preserve and protect depositors from this insolvency potential, then regulations impose minimum capital requirements. The Federal Reserve is the central bank of the United States, and as a central bank, they're responsible for regulating the monetary system. They control the money supply, primarily using open market operations, buying and selling bonds. Purchasing bonds increases the money supply. Selling bonds decreases it. And that's everything for Chapter 16. Chapter 17 will follow and be highly related to this, as it looks at the growth of the money supply and how it influences inflation.